Welcome back, Alpha Hunters! Today we're going to go over a new order type, the Straddle and the Strangle. Now they're two different orders, but they're set up very similarly. And then I will give my thoughts on the order and best practices on how to use it. And then we will look at the risk profile chart in Thinkorswim. So let's get it going. So to set up a Straddle and a Strangle, you notice you buy a call, nothing different there. You buy a put, nothing different there. But the only difference is the strike. For the Straddle, the strike is going to be the same for the call and the put. The Strangle is going to have a different strike for the call and a different strike for the put. So the Straddle and the Strangle have many similar characteristics, such as you're buying a call and a put. Now what you're looking for in the direction of the stock is a dramatic move in the up or downward direction. For cash flow, this is going to be a debit type trade. So you're going to be paying money out. And your losses on this trade are anything between the break-even points. Okay, now the lower break-even is going to be the lower strike minus the premium. The upper strike is going to be the higher strike plus the premium. And then your profit is going to be anywhere outside those break-even points, to the upside or downside. So my thoughts on these orders, they're easy strategies to understand and comprehend and execute in your broker. But the downfall is going to be they're an expensive trade to put on, right? Because you're buying a call and you're buying a put. Now this is going to be a Delta and Vega play. What you're expecting is a dramatic move. So if there's a dramatic move, Delta on one of those positions is going to increase faster and have more impact than the other one loses. But it's also a Vega play, as an increase in volatility will increase the value of both options at the same time. But the major problem here is going to be theta. Theta is going to eat away at both positions every day as time goes on. So when you're wanting to look to put this on, you want to give it some time, but you want a catalyst type of situation, such as like when a stock gets to a key level and you're expecting another dramatic move off that key level. So if it comes down to a support or if it hits another resistance point that it has made a dramatic move from that point before, that is what you're looking to do. And this is going to be a much better approach than guessing on which way the stock is going to move. Lastly, I've just found that these are not consistently reliable to implement into a trading plan, but they are useful in certain scenarios and use cases. Okay, so let's look at a quick example of how to use the straddle real quick. Okay, so say we have a stock at 135. Okay, so we're going to look to buy the 135 strike. Okay, and the call that is trading at the 135 strike is at 650. It's trading for 650. And the put is also trading for 650. Now, the premium that we're going to have to pay out, since we're going to have to buy both of those positions, is going to be $13, right? So then what we want to do is figure out what our break-even point would be. So we just take the strike price minus the 13, and we get our lower break-even at 122. And then to calculate the upper break-even, we just take 135, the strike price of 135, and then add the 13 of the premium, and we get an upper break-even of 148. So anything between 122 to 148 is going to be a loss, and then anything outside of those two numbers is going to be profit. Well, what about the strangle? Okay, so how we want to set that up? Let's say the stock is at 135, which is a key pivot point. Okay, instead, we're not going to buy the 135 strike. Well, instead, let's buy the 130 and the 140. Okay, so for the call, we'll buy the 140 strike at 580. And then for the put, we'll buy the 130 strike at 580. Now, the premium is going to be a little bit less than buying the straddle. You know, the premium out that we're going to have is 1160. Right? You add the 580 together with the 580, you get 1160. So then we're going to take that 1160 and figure out what our break-even points are. Okay, so we'll take the 130 strike, because that's our lower strike, and then we will subtract out the 1160 of our premium, and then we will get a lower break-even of 118.40. Now to figure out the higher break-even, we will take the higher strike of 140, add 1160, and then we will have the higher break-even of 151.60. And then anything between 118.40 and 151.60 is going to be the loss, and anything outside of those two numbers will be the profit. So as we can see, even though we paid less premium on the strangle, so we have less risk on the table, we need a more dramatic movement from the stock by expiration to become profitable. So they both have their use cases, and it probably just depends on what you are expecting out of the stock. If you appreciate these breakdowns, give me a like and let me know in the comments if this is working or if you need better explanations. Now give me a quick second, I'll switch over to the broker and then we can look at some risk profiles of how these two trades work out. Okay, so here we are back in Thinkorswim. I am in my simulated trading session and we are just going to look real quick at buying a strangle position and a straddle position. And we'll look and see what those risk profiles look like so that you get a better picture and understanding of what you're expecting out of the trade. So what you want to do is you can right click and buy a straddle, okay? But if you don't have this kind of tool, what you want to do is you can just buy a single position. You can buy that. So we'll say we'll analyze this. We'll send this over to the analyze. And then we'll come back over to the options chain. And then we will analyze this put, the 467 put, okay? So we'll send that over. And you notice they are not exactly the same price. And that is fine. One might be a little bit more in the money than the other, so it'll have a little bit more value. But what we notice is it is very much a V type of risk-reward profile on the expiration date line. Okay, and that is what the teal line represents, is the expiration date, the value of these two options on the expiration date and where you can expect to make money and where you can expect to have your max loss, which is right here at this pivot at 467, right, which makes sense because that's where we bought our strike. So that should be the lowest value point. And so you can see where your max loss would be, and then you can see where your break even would be is where the teal line intersects with the zero line. But like I said, one of the major problems with the strategy is as you watch the purple line, and the purple line is the value of the trade on whatever day we are on. So right now we're looking at December, the value of this trade on December 22nd. So as we move forward in time, and I'll move forward in time with the calendar down here. So as we move forward in time, you'll see that purple line will decrease and will just continue to decrease in value. So you are losing money if you are not getting that dramatic move that you expected. Okay, so this is very beneficial to get that move early, quick, fast, any other word that you want to use to describe and getting that move now as fast as possible. Okay, so that is how a straddle will look. As you buy, you have a bought call and you have a bought put. Okay, so let's stagger them. Okay, so we're going to stagger these, and we will have this put go to, we'll say, we'll make it a little bit wider. We'll say 464, and this call, we'll take this call up to 477. Sorry, nope, that's a little far. We'll take it to 472. So we have an $8 difference between the call and the put. And let me refresh these prices. And so you can see our max loss is less than the straddle, right? We're paying less out for the trade, but our break evens did go wider. They did go wider. So what we can see here is we actually have a range now, not just a point, but a whole range where we can have max loss. Okay? Between, what is that? It should be between 472 on the upper side to about the 464 on the lower side. So what you can expect is theta very much, as we roll this forward in time, is that purple line comes down, and it comes down pretty quick because both of these options are actually out of the money, and so they can get down in value pretty quick. But the trade does cost less, so you're actually paying less for the trade, but you are needing a wider move. You're needing a higher move from the stock. Okay? And volatility is also another one of those things that will increase the value of your options because you own both of these options. So as you're as your volatility increases, Vega will increase the volatility or the value of the option based upon how much Vega says. Okay? So, hope you enjoyed this breakdown. Like I said earlier, these are very easy trades to understand and to implement, but these are kind of tough trades to execute a little bit because theta hurts so much. So when you do these type of trades, make sure you are buying plenty of time. Make sure you're going far out in time. That way theta is not hurting you as much. And gives you time to see if the stock is going to make the move you were expecting or not. And if you want to see how Vega can help out this trade, click the video in the top left and it'll give you a breakdown of Vega. Alrighty, take care, Alpha Hunters.